Inflation is cooling down. Interest rates are still high. Experts are all over the place, arguing about what comes next. Is the economy having a soft landing, or is a recession right around the corner? It feels impossible to know who to listen to. Are we safe now? Or are we just standing right in front of the next big storm? Here's the thing. You don't have to guess. Let's build a financial plan that works no matter who ends up being right. A strategy that survives every single cycle. First, let's get clear on what cooling inflation actually means. It's a phrase we hear everywhere, but it's often misunderstood. Seeing inflation cool down doesn't mean prices are going back to where they were 2 or 3 years ago. Your rent, your groceries, the cost to fill up your car, all of that might still feel expensive. Cooling inflation simply means that prices are rising more slowly than they were before. The speed of the price increases is slowing, but they're not reversing. So, while it's good news that things aren't getting more expensive as quickly, it's not the same as things getting cheap again. So why are things slowing down? A big part of that is interest rates. Think of the central bank as the driver of the economy, and interest rates are the brake and gas pedals. When they raise interest rates, they're pressing the brake. It makes borrowing money more expensive for everyone, for individuals buying a house or a car, and for businesses looking to expand. This discourages spending and investment, which helps to slow down the entire economy and bring inflation under control. On the flip side, when they lower interest rates, it's like they're easing off the brake. Borrowing becomes cheaper, which can encourage spending and give riskier assets like stocks a boost. But sometimes, cutting rates is also a signal that the economy is weak and needs a little help to get going again. The key takeaway is that rates are a tool used to either slow down or speed up the economy. With all this talk of inflation and interest rates, it's easy to get lost in the noise and feel like you need to be an expert economist to manage your money. But you don't. The truth is, no matter what the economic cycle looks like, your money always has the same 4 fundamental jobs to do. First, to protect your basic needs. Second, to give you breathing room. Third, to grow for your long-term future. And fourth, to handle any optional risk you decide to take on. The markets will always change. The headlines will always be confusing. But these 4 jobs for your money, they never change. This is the foundation of a strategy that lasts. So let's break down those jobs, starting with the first 2, protect and breathe. Step 1 is to protect your essentials. This means creating a realistic budget that covers your non-negotiable costs: housing, utilities, food, and transportation. I'm not talking about a fantasy budget where you pretend you'll never eat out again. I mean a real honest look at what it costs you to live. Once that's covered, you move to step 2, building your breathing room. This is your emergency fund, a buffer that can cover 1 to 3 months of those essential costs. This is the single most important thing that keeps you from having to make bad decisions in a panic. Like selling your investments at a loss or taking on high-interest debt when things get tough. Protect and breathe. That's your fortress. Once your fortress is built, it's time for step 3, grow. This is where you focus on building wealth for the long term. The most effective way to do this for most people isn't by trying to time the market or pick the next hot stock. It's by creating a core growth strategy built on broad, diversified funds. Think of index funds or ETFs that track the entire market. The plan is simple. You invest a set amount regularly, automatically every single month, no matter what the headlines say. You're not trying to perfectly predict when the central bank will raise or lower rates. You letting time in the market and the power of consistent contributions do all of the heavy lifting for you. This approach is powerful because it's automatic, it's diversified, and it's focused on the long term. Now for the final job, handling optional risk. This is step 4, and notice I said optional. This is where things like picking individual stocks, investing in crypto, or making other speculative bets come in. If you choose to do this, the key is to treat it like a satellite to your core portfolio. Keep it a small, clearly defined slice of your overall wealth money that you could genuinely afford to lose. We're talking about an amount that, if it fell by 50% tomorrow, wouldn't ruin your financial plan or keep you up at night. In any economic cycle, your core financial plan should be solid and, honestly, a little boring. You don't want the money you need for rent to be on a wild roller coaster ride. That excitement should be reserved for a small, separate pile of cash. At the end of the day, you don't need to win the inflation guessing game. You don't need a crystal ball to know what interest rates will do next year. What you need is a durable, all-weather strategy that works whether inflation is up, down, or sideways, and whether rates are high or low. It all comes back to those 4 jobs: protect your essentials, create breathing room, grow for the long term, and manage any extra risk wisely. Your behavior and your plan are infinitely more important than any prediction. Please remember, this video is for educational and entertainment purposes only and should not be taken as financial advice. For more calm strategy and less daily noise, make sure you follow and subscribe. Thanks for watching.